You don't require the passage, you require the momentum. If momentum is not there, better you hit out and get from your trading positions. If I just give an example, if I ask you, is there any doubt? Or if I say, what about the Rahul Dravid? Isn't a good player? I'm sure everyone will salute to the Rahul Dravid and say, he used to be the wall of the Indian cricket. But if I tell you, can we take the Rahul Dravid in the opening of IPL T20? I'm sure everyone will say, no, he's not the suitable person. Because every player has their own style. And the right style for the right game is required. So Rahul Dravid is good for the test matches, but not suitable for the T20. Because T20 is all about time-bound movement, time-bound target, time-bound score. So derivatives and the option is all about the time-bound target, time-bound score, and the time-bound movement. If I say that Virat Kohli has come after 2 wickets and he has not scored anything in 5 overs, what is your advice? You say, better you hit out. Better you go with the hit wicket and go for the catch out. But don't waste over, because these are the 20-over match. And making the score is very important compared to in test matches where saving the wicket is more important. So both the game, however, we are in cricket, but the format and the style is totally changed. So we need to understand the format and concept, and that's why the understanding of derivatives is very important. So what I understand, when you are a trader, you need to know about the style of the T20. But when you are an investor, you need to know about the style of the test matches. More you stay for the longer time, more the result will be there, like the test matches. But for the T20 or for the trader, you need to know the concept as per the trading or the T20 point of view. Now, if I talk about the next image, next picture, that is the systematic way of the options in the derivatives trading. See, when you trade in the derivatives, as we discussed a lot about the different type of format, like test matches, one day or the T20, similarly, long-term trading, short-term trading, and the intraday trading. See, there are 4 types of trading behavior. One is the positional. No need to look at the technical, just looking at the fundamental. We want to buy the right company, that's all. We don't want to look at the chart because we don't want to exit. We want to own the company. Like, I don't have capacity to start my own Maruti and Infosys, but I want to be the partner of Maruti or the Infosys. So what I'll do, I'll put my money into the shares of Maruti and I'll be the partial owner of that company. But now the question is how to trade those stocks. So that is all about the long-term trading investment, but the positional trading means buying, holding for a few months. Then your swing trading is buying right now, holding for next couple of days or couple of weeks. Or intraday trading is just trading now and exiting now. So more you dig down, more you deep down from your long-term investment to the short-term trading, more skill set is required. So those who are the full-time trader, they can only do the intraday trading. Those who are doing the part-time trading, they only can go with the swing trading. So those who are having the different business but having the separate money and want to invest, they can go with the long-term positional or investment. So everyone need to find out your style, and then only you can be in market, whether you talk about derivatives or whether you talk about the fundamentals. Now the systematic way of trading, it may be the options trading or the future trading. First, what is your market outlook? And now I'm more talking about the T20. Now I'm not bothered about your test matches because I'm talking here about the technical and derivatives. So first you need to know about the market outlook, that what is the market outlook. So now let's say Nifty can go to 12,000 in the next 3 years. So I cannot take position based on these assumptions because I'm more about the trader, whether I need the view on the weekly expiry and the monthly expiry. So I can say the Nifty can be in range of 8,500 to 9,500. That is fine for me. But if I say Nifty can go to 12,000 in next 2 years, that is not sufficient reply for me. So whenever I talk about the derivatives position, I need to know about the outlook, but that is based on the time-bound outlook. Then I don't know what is the request. Okay. So now after that I need to look at the position sizing. So how much position should I buy a call or should I sell a call and what else? Then entry and exit, everything is important. Even in the options, the important part is how much contract to buy, how much contract to sell, which strategies to go for. And exit is very important in derivatives market. You must have heard about the Mahabharata. And right now in the time of the lockdown, Mahabharata and the Ramayana are the famous episode. And in Mahabharata, you must be knowing about the Abhimanyu. Ghus to gaya tha, but nikal nahi paya. And exactly that happens in the derivatives. And exit is very important in the derivatives market. Entry anyone can do based on some logic, but exit is very important. And the only problem is we don't know when to exit the positions. So I'll talk about some concept of the markets. So now first let me tell you what is options all about. I think my PPT is just getting updated. So, but I'll continue the conversation. So what I understand, what I need to know, what is also option all about. So now I'm coming with the future and options. I'll differentiate first. I want to differentiate what is the case market, what is the future market, and what is the options market. So let's say I like to buy one company, and because I like the business model of the company, I want to buy that company, or I may be interested to get the immediate benefit of that price movement. So I want to differentiate between the three things. I want to differentiate between your fundamentals, your technical, and your derivatives part, right? Or mainly I want to differentiate between your long-term positional trade, your derivatives trade, and your option trade. So I'm just taking an example, what is the derivatives all about and how to differentiate it. So now let's say I'm a person and I'm interested to buy Reliance shares. I'm just sharing one example. Let me check that example if I have. So what I understand here, that first we need to know what is the derivatives all about and how the derivatives is being differentiated from the other part. So I have an example over here. Yeah. So look at this example. I think, again, let me share this PPT. Yeah. So look at this example. I want to differentiate first what is the derivatives all about. So I have taken an example that Reliance is trading at 1,000 rupees. And I am having the view that Reliance can go to 1,100 rupees. But if it fails to move above 11,000, it can go to 900 also. So here I have positive view on the Reliance. So I want to buy the shares of the company. So I have three scenarios: buy in case, buy in future, buy in options. So future and options are part of derivatives. Case is all about holding the portfolio. So what I've done, I bought 500 shares of Reliance at 1,000 rupees. So my investment is 5 lakh rupees. Now if the Reliance goes to 1,100 rupees, I bought it 1,000. If it goes to 1,100 as per my view, I'm having the profit of 100 rupees per shares as I bought the 500 shares. So my return is 50,000. My total investment was 5 lakh because I bought 500 shares at 1,000 rupees. So my investment is 5 lakh rupees. But stock has moved by 100 rupees. So I made 500 multiple 100. That goes to 15,000. So I'm making in profit of 15,000. So when I'm buying in case market, that means I'm giving entire money as an investment. I'm personally owner of that company. I'll get the benefit of the dividend, bonus, and right issues or whatever the voting power. So here in this scenario, my return on investment is 10%. Because I'm getting profit of 50,000, I investment 5 lakh rupees, so my return on investment is 10%. But as per my view, Reliance has not moved up, it has gone to 900. So now what? I'm in loss of 50,000 because I bought it at 1,000 and now it has gone to 900. I'm at loss of 100 rupees multiplied by the 500 shares. So I'm at loss of 50,000. So my risk on investment is 10%. So this is how we understand the return and the reward in the case market. Now I'm taking the example of the future market. So similarly, like the case market, I have the positive view on the Reliance. I'm expecting it to go to 1,100. So I'm buying one lot of Reliance. And in derivatives market, there are 142 NSE FNO stocks. So I can trade only in those counter which are in derivatives in the future segment. So now let's say DMart is not in future, so I cannot buy the future lot. ICICI Bank in future, so I can buy in future. In case market, you can buy any number of share, 1, 2, 3, 4, 5, whatever. But in future, you can only trade in the lot size. And now let's assume that lot size of Reliance is 500 and you are buying the one lot of Reliance. So in future, you can only buy in the lot size. So lot size is 500. You are buying one lot of Reliance. Let's say price is 1,000. So value is 5 lakh. But in derivatives segment, in future segment, no need to pay the entire margin. No need to pay the entire value. You need to pay only some percentage of the market, because when you are trading in derivatives, that means you are not partially owner of the company. You are not going to get the benefit of the dividend, voting right, or bonus. only benefit is the leverage, that no need to pay the entire value. You need to pay only some percentage in terms of margin. So let's one example. For Reliance, the margin is 20%. So for entire value, you need to pay only the 20% margin. So let's say the 5,000 rupees multiple the 500 shares, one lot you are buying. So investment, so your lot value is 5 lakh. You need to pay only 20%. So your investment comes to 1 lakh rupees. Now, if the same Reliance moves by 100 rupees and you bought one lot that includes 500 shares, so you are in profit of 50,000 and you will be getting 50%. So return on investment is 50% because your investment was 1 lakh rupees in derivatives market. The only benefit of future or derivatives is leverage. And you invested only 1 lakh rupees and you made 50,000 rupees, which you same made in cash market. But in derivatives, you only pay to the certain amount of margin, right? Same that if the future goes to 900 rupees, you are losing 50,000. So your risk is also the 50%. So derivatives for the future is high leverage trade where your return is higher, but your risk is also higher. Again, I'm talking about the option segment. So in future, when you are buying some shares or buying one lot of any particular counter, if it moves up, you are in profit. If it goes down, you are in loss. But the problem is in future is when particular stock goes down after you're buying, you need to pay mark-to-mark margin. So after the initial margin, you need to pay the mark-to-mark margin. And that is the biggest problem in the future market. Let's say you bought Reliance one lot, that means 500 shares of Reliance at 1,000 rupees. So lot value is 1 lakh, but you need to pay only 20%. So you invested around 1 lakh rupees. So you need to give your 1 lakh rupees to your broker. And at that time, you can buy one lot of Reliance. So that means 5 lakh worth of value you can buy just by 20%. But if your position goes down, you need to pay mark-to-mark margin. Again, one more advantage of future is, or again, one more advantage of derivatives is, you can sell also, but in cash market, you can only buy. You can buy and hold, but you can sell intraday, you have to carry, but you cannot sell and hold to the next day or next few weeks or few months or so. So what I understand, the advantage of derivatives is you can buy as well as sell, but in cash market, if you're not holding the position, you cannot sell. So this is the biggest advantage. Now, you cannot get the benefit only through the cash market. Only the decline you can get benefit only through the derivatives market where you want to sell something. Now I talk about the options market. So now let's say options are similar to your insurance, like what you do in insurance. When you have to buy some insurance, you have to pay the premium. Similarly, in equity derivatives also you have to pay the premium. So now what I've done, see, if I just explain the definition of the derivatives is a product whose value is derived from the value of underlying. Derivatives or future is a linear product, and if you bought it and moves up, you are in profit. If you bought and goes down, you are in loss. Whatever it moves up, that is your profit. Whatever it goes down, that is your risk. But if you talk about the options, there are two types of options. One is the call option, second is the put options. Options means when I'm buying an option, that means I have right to buy an underlying, but not obligations. So similarly, in this example, I am buying Reliance at 1,000 rupees and paying the premium of 25. So that means my maximum cost for buying Reliance at 1,000 will be 25. If Reliance goes to 500 or 400 or 0, I'm not going to lose more than 25 rupees because already I paid the premium of 25, like an insurance product. I paid my premium. That is my maximum risk if I don't get the claim. Similarly, here also, if Reliance goes down, my maximum risk is the premium of 25. But if it goes up, I'm in profit. So let's look at this example. I bought 1,000 rupees call of Reliance at 25. And if it goes up, I'll be in profit. So now in the same example, if Reliance goes to 1,100, I'll be in profit because I bought 1,000 rupees call at 25. So my break even is 1,025. When I'm buying a call by paying some premium, for sure that premium paying is my cost. Similarly, let's say I've done the Mediclaim at 7,500. And after Mediclaim, I got the reward of, let's say, 30,000. So my profit is not 30,000. That profit is 22,750 because 22,750, whatever the premium, let's say 7,500. So that will be 30,000 minus 7,500, 22,250 or 22, whatever the amount the differentiate from the premium. Now, similarly, let's say I bought Reliance call, 1,000 call at 25 rupees. So my maximum risk is 25. Here I'm buying 500 quantity everywhere, so my investment is 12,500. So if after buying 1,000 rupees call at 25, Reliance goes to even 400, 500, 900, 800, my maximum risk is 25. But same time, if Reliance goes to 1100, I'm in profit. My break even is 1,000 plus 25 because I'm ready to buy Reliance at 1,000. That's why I'm paying the premium of 25. My break even goes to 1,025. Now the Reliance is up by 75. So I'm in profit of 75 multiple the 500. That goes to 30,500. If Reliance goes lower, my maximum risk is only 25. There's been 25 into 500, that goes to 12,500. Now I compare the example. If you buy in cash market, your investment is 5 lakh. If you buy in future market, your investment is 1 lakh. If you buy in options, your investment is 12,500. Now, if the same Reliance goes to 1100, your return on investment is 10%. Same Reliance, if goes up in future, your return on investment is 50%. If the same Reliance goes to 1100 in options, your return on investment is 300%. Now, looking at the downside, in your case market, your risk is 10%. If it goes to 900, your risk is 50% plus mark-to-market margin. But in options, it's only 12,500. It's that 100%, but only 12,500. So this is the differentiate between your case market, future market, and derivatives markets. Now I'll talk about the other examples to know about I'm sure everyone must be knowing about derivatives because frankly speaking, derivatives is one of the toughest subject. And earlier in my college time, I used to read this subject to get a proper sleep. So I'm sure many of you must have not slept. So I just try to explain the derivatives. Actually, it's a very tough subject. Even my PPT is getting end. Let me again look at my task manager. I'm in tasking and again starting the PPT. Yeah. So again, we can see the slide of the derivatives markets. As I mentioned that when you need to know about the style, I explain what is the derivatives, what is the difference between the spot derivatives and the future. Now I'll talk about the key thing, options, because when you are buying in future, everyone knows when you're buying in future, you need to pay the initial margin and after that you need to mark-to-market margin. Future is having the linear payoff. If it moves up after buying, you are in profit. If it goes down, you are in loss. But important part is to understand about the options. So I'll simplify the options. So you need to look at the two types of options. One is the call and put. There are two types of options. The call options means you have right to buy, but not obligation for buyer. Put option means right to sell. So if you are buying call, that means you have positive view. If you are buying put, that means you are having a negative view. So let's say in the market, you are expecting market to go down. So you have to buy the put. If you are expecting market to go up, so you have to buy the call. So I'll take one example of future versus options trading, and then I'll talk about who makes money, whether the buyer and seller. So in this example, if you look, I've taken the example long back. I'm just taken the rough example. Now let's say the Nifty future is trading at 12,000, and after one day you are expecting it to go up, and let's say it moved up to 12,050. So what is your profit? I'm sure you'll say 50 rupees. Let's say it gone to 12,100, so your profit is 100. If it goes to 11,950, you are in loss of 50. If it goes to 12,000, you are at cost to cost. If it goes to 12,150, that means you are at profit of 150. So that is the easier or linear payoff. Whatever it moves up, you are in profit. Whatever it goes down, that is your loss. So that is how the future trading is being conducted. But now I am talking about the options. Now let's say the market was trading at 12,000. And now I am interested to buy 12,000 call at 100 rupees. That is, let's say trading at 100 rupees. So if I'm expecting the positive move, I can buy future, but I don't want to lose much. I have limited money to pay and I want to buy in options because if market goes down, I don't want to bear the unlimited risk. So I bought this 12,000 call at 100 rupees. So now I want to explain when you're buying a particular strike of options, you have to pay the premium, while seller has to receive the premium. So when you're buying 12,000 call at 100 rupees, So that means your break even goes to 12,100. Now let's say I'm expecting Nifty to go to 9,500. I'm taking the real time example. Let's say I'm expecting Nifty to go to 9,300 and I'm buying 9,000 call at 100 rupees. That means my break even is 9,100. And if it goes to 9,300, I'm in profit of 200 rupees. But actually, your Nifty has gone up by 300 points from 9,000 to 9,300. But your profit is only 200 rupees because 100 rupees you paid as a premium to get that right to buy the Nifty at 9,000, and your break even goes to 9,100. As it moved to 9,300, so your profit is 200 rupees. But what happens in the real time markets? Your premium moves in line with the market movement. So what I understand, I'm just giving you thumb rule. If market moves up by some point, your at the money call moves by 50% of the same. So in options, you need to know about 5 Greeks. Those 5 Greeks are delta, gamma, theta, vega, and rho. Delta means change in option premium because of the change in underlying. Gamma is change in delta itself. Theta is change in the time value, and your vega is change in the volatility, and rho is change in the interest rate. But in terms of the practical exposure, you need to know about the 3 things. 1, market movement, market underlying. If Nifty moves up, your call will move up. If Nifty goes down, your call option will go down. If Nifty goes down, your put will move up. If Nifty goes down, your put will fall down. Second thing will be time. And time is the constant and keeps on reducing. That is a fact of the life. So as the time passes, your premium of the options decline. And third part is volatility. If volatility moves up, your option premium will move up. If volatility goes down, your option premium will goes down. So here I've taken an example. Let's say you are buying 12,000 call at 100 rupees and you are interested to buy this call only for 1 or 2 days. So as per the delta, that is a thumb rule. You need to know that at the money call before the expiry remains half of the movement of underlying. So now if you look at this example, your Reliance has moved by 50, your market has moved by 50 rupees. So this option will move half of the underlying movement. So it will move by 25 rupees. So theoretically, this price should be 100. So as per the scenario analysis, your price should be 125, but this movement is happening after 1 day. So your premium will be 123. Look at the next example. Your market has moved by 100 rupees. So as I mentioned that at the money call has half delta. So it should move by 150, but it is moving by 145 because your movement is happening after 2 days. In third example, your on third day, market has gone to 50 rupees down. So as it is moving by half, so it will fall by half only. So it should decline by 25 rupees. Your premium should go to 75, but it is going to 65 because that movement is happening after 3 days. Because this 100 rupees premium is all about your time value, and that will zero towards expiry. And that is the only advantage for the option seller. And that is the only risk for the options buyer. Now, if you look at the 4th day, your market is at the same price, but your premium has gone down by 12 rupees. It has gone to 88. So 12 rupees is risk. So here, if you look at the comparative analysis, what is better to buy future or buy option? Many maybe say that buying future is better, but you need to understand in option, you are only losing 12 rupees. If it goes down, your maximum risk is 100. Your investment is only 100 rupees multiplied by the lot size. But in future, your investment is the total margins of 10%, 12%. So as of now, if someone trade in future, the investment is 75,000 rupees. But if someone buys at the money or slightly out of the money call, your investment is only 7,500. There is a big difference to buying in future compared to buying in options. But again, the big disadvantage for option buying is the time decay. As the market consolidates, as the time passes, your premium has to go down. So option traders trade when they are expecting direction move in the market or volatility in the market. Now look at the 12,000. If it remains at the same, your premium goes down. Now let's say expired 12,150. It moved by 150. And I given the scenario or thumb rule, whatever the market moves, make the half of it, that should be the movement. But now we are on the expiry. And what is your break even? 12,100. And it is 50 points higher than the break even. So we are in profit of 50. So in scenario, whatever the market moves, your at the money option moves by half. Now how to know at the money? At the means the strike which is near to the market. Now out of the money, delta might be different. And how to get the delta? Delta is all about change in option premium because of the change in underlying. Now let's say your Nifty moved by 100 rupees and your particular option moved by 25 rupees. That means the particular options has delta of 0.25. Let's say your market is corrected by 100 rupees and your put has moved by 70 rupees. That means your put has delta of 0.7. Now let's say your market is moved by 150 rupees and your call is moved by 50 rupees. That means your call is having delta of 0.33. This is how you can identify and understand the delta. Now, in day-to-day market, you need to know the option premium movement by delta, but toward the expiry only, you need to know about the break-even. You bought 12,000 call at 100 rupees, your break-even goes to 12,100. It is higher by 50 than the break-even, so you are in profit of 50. So this is how the difference between the future market and the options market. Now I'll just look at the key thing, the difference between the options buying versus option selling. So if you look here, the difference between option buying versus option selling. See, there are two types of traders at a time in options. One is the buyer, second is the seller. So now let's say, just for an example and theory point of view, let's say market is 12,000. What may happen on expiry? It may up, it may go down, it may remain same. So there are only three scenarios as per the theory. And I am buying 12,000 call at 100 rupees. So my break even is 12,100. If market moves about 12,100, then only I'll be in profit. If it remains near to 12,000, I'm at loss because my 100 rupees will go to zero. If it goes below 11,900, I'll be lost, but I'll be happier because I'll be losing only 100 rupees. So out of three scenarios, because market may move only three sides, either upside, downside, or the same. So out of three scenarios, option buyer only makes money in the one scenario. So as per the theory, the probability of making money into the option buyer is 33%, while probability for making money for the option seller is 67%. So this is what I understand. So now how to get the execution based on the same? So what I understand is the option buyer has probability to make money by only 33%. Seller has probability to make by 67%. So that means if you're option buyer, don't buy option every day. If you're buying option every day, that means 67% time you are donating your money to the option seller. So for option buyer, you can, it doesn't mean that you cannot make money. Buyer can make money, but only your trade should be in the market for 33% time. Now you are getting the clue that you should be trade only for 33% time. But now the problem is which 33% time. So what I do generally, I buy options on volatile day. Now if I ask you which are the volatile day nowadays, so you'll say Wednesday and Thursday because of the weekly expiry. So there are 22 trading sessions. Out of 22, there are only 7 to 8 days you should trade in option if I just look at the 33% probability. So what I do, I trade options on expiry days, Wednesday and Thursday, or at the time of trending market or the breakout markets. Otherwise, I don't buy the options. So you can buy options when market view is bullish or bearish, but the direction is very clear. But when market is in range, you cannot buy option because if you buy options, your premium of options will decline and that is benefit to the options writer. So this is what I understand, and based on that, I try to find out the market movement and try to find out when to be the option buyer versus option seller. So this is the required to understand the trading setup. I'm just talking more about the index because that is more popular nowadays and more easy to learn and quite liquid in such scenario. So let's say someone is interested to trade options. So what is the setup? First, you should know what is my market view, whether the bullish, bearish, but only bullish, bearish is not required, whether the range bound. Like right now, let's say the market closed at 9,000. So what is the requirement? Are you expecting positive view or negative view? Let's say I'm positive. So you'll ask me till what level? Do you have positive to range bound or the only positive view? So like I can say, as per the data today, I was expecting market to move in between 88 to 9,050. And exactly market moved in a range. So I have positive to range bound bias. So accordingly, I can play that I cannot buy call of 9,000. I cannot buy call of 9,050, but I can trade in call of 9,000. I can buy 8,950 call. I can sell 9,050 or 9,100 call. I can sell 8,900 put because I'm not expecting below 88. So based on this scenario, we need to know that whether our view is bullish, bearish, range bound and volatile. And how to know this view? You can know by technical, you can know by the option data, you can know by the movement in heavyweights counter, and you can know by the sentiment. If you look at the market from last couple of weeks, market was making lower top, lower bottom. For last trading session, it has negated the same. But good part is from last few days, we are witnessing decline in the volatility. And everyone knows the volatility and market is negative correlation. So your volatility, which was at 86.60 couple of days away, has gone to 46. So volatility is cooling down, and volatility and market is negative correlation, and that's why we are witnessing some sort of support-based buying in the market. So these are all parameters you need to know to be a perfect options or the derivatives trader. And whatever you find out the target, that should be the time bound. Time bound target can be applied in the derivatives markets. Now I'm looking at the next part. After finding out the setup, the execution is important. First, setup means first we discuss what is the market, first we started the difference between the derivatives market, what is options versus future. Then we discuss on how to be what is the difference between buying in case market versus future and options. Then we look at how to do the options trading. Before that, we discuss about the trading style. What is the difference between the trading versus investing? We also look at when to enter, when to exit, which are the strikes, what is the options all about. We did the scenario analysis. Then we did look at the thumb rule of the trading. Then now the thumb rule of the executions. Now, what is requirement? First, the setup is requirement, and then how to execute the setup. Which call should buy, which futures should buy, should I buy now? Let's say market is at 9,000. Should I buy 9,000 call or 9,050 call or 9,100 call? Or let's say I have positive view. Should I sell 8,500 put? So these all scenario analysis we can do based on our expertise. But the different way of understanding is required to be a perfect options or the derivatives trader. Already we discussed about the factor which are affecting the option value. Delta, gamma, theta, vega, rho. But in practical terms, market direction, time, and the volatility. Now, this is an example. This is the example is the previous PPT I'm opening here. So the levels are different. But here the conclusion is when you're buying options, you should buy nearby strike, which are having more delta or 0.5 delta. But you are selling option, you should be selling out of the money strike, which are having the delta, lower delta comparatively. Now I'll talk about some concept. The discipline is very important. When you talk about derivatives, if you're not following discipline, you cannot make money. Discipline is the important part of the derivatives segment. Discipline means whatever you trade. See, first you have to believe out of 10 trades, 10 out of 10 are not going to be right. So when you're going road, better to cut your position, and always be saying derivatives, better you cut your finger rather than cutting your hand. And risk reward ratio and discipline very important. Many people, they buy it. Let's say someone has bought at 100, interested to sell at 102, but unfortunately that gone to 90. He's not now ready to sell because he want to sell at 100. Earlier when it was 100, he was ready to sell at 102. Now let's say price is at 90 and gone to 85. Now he's expecting it to go to 90. He's ready to sell at 90, ready to lose 10 rupees. But when it was 90, he was looking at 100. Now let's say price is gone to 80. Now he's looking to go back to 85. He's ready to sell and say, I'll sell even if loss of 85. 15 rupees. Now let's say it goes to 65. Now he's looking for 75 to exit. And if it goes to 50, he says, I have capacity and I can hold it because long-term future is positive for the company and some magic will come and the price will go to 50 to 500. So discipline is very important, whatever you trade in the derivative segment. When you are ready to exit in profit of 2 rupees, try to exit in loss of 1 rupees or 1.5. If your risk reward ratio and discipline is not up to mark, you cannot make money in derivatives, even in this life or even in the save birth. So trading in derivatives and making money is one of the toughest part. Risk reward ratio is very important. Now let's say one of my friend trade in derivatives. He buys at 100, sells 101. Out of 10 trades, he had done 9 times. He made 9 rupees. So you can say if out of 10 times he's right 9 times, accuracy is 90%. But 9 times he made 9 rupees, 1 time he lost 20 rupees. So your accuracy is 90%, but net to net you are losing 11% even after being the 90% probability. So only accuracy is not important. Your discipline and the money management and the risk reward ratio is important. Then only you will make money. I'll talk about some basic approach and then I'll better to make it two-way communication because I don't know whether you are learning or not, you are understanding or not. However, I'm trying to put real-time practical examples. So what I understand in derivatives is the game of the options writers. Option writer makes money most of the time. So whatever data we look on day-to-day point of view, we understand The writers are there in the markets. If I talk about the option point of view, again, you need to understand derivatives is a zero-sum game. If you are making money, someone is losing. So if you are trapped, likely to trap more. If someone is making, is likely to make more. And how to know whether someone is trapped or not? That can be known through the averages. Now, let's say for an example, the Nifty is trading at 9,000 and average is 9,100. That means we are lower than the average. That means the bulls have trapped, so more selling can come. Now, let's say towards the expiry, the average of Nifty is 9,000 and we are at 9,000. So what is conclusion? That conclusion is market is not going to move anywhere. It's likely to be here only because no one has trapped. So why market should move up or down? Then there are some concepts regarding the put-call ratio, volatility, Hayward's counter. I'll just talk about the Hayward's counter and the index movement and the Bank Nifty movement. So if I ask you if India has to win, what should be the strategy? There are 11 players. We cannot take all the 11 as a bowler. We cannot take all as a batsman. We cannot take all as a wicket keeper. We cannot take all as a fielder. So what is required? The diversify. Okay. Now there are 11 players. If 11 players plays well, then only the team can win. Similarly, now the Bank Nifty is also the combination of 12 players. If the 12 players do well, then only the Bank Nifty can do well. So if you know that your 12 stocks are doing well, you can understand that Bank Nifty looks good. You can buy future or you can buy options. Now let's say my HDFC Bank, which is having highest weightage, is similar to my MS Dhoni. So like if MS Dhoni plays well, you are having more chances for Indian team to win. So similarly, if HDFC Bank is doing well, more chances for the Bank Nifty to do well. And you must have seen today HDFC Bank was moving up. So your comparatively Bank Nifty was not falling down. My ICICI Bank may be your Virat Kohli. If that moves up, then only my Bank Nifty will see the momentum. So what is the conclusion over here? The movement of Hayward's counter is very important. There are 12 stocks in the Bank Nifty and 4 to 5 stocks are contributing more than 33%. So the movement of Hayward's is very important, like HDFC Bank, ICICI Bank, Axis Bank or Kotak Bank or SBI. If these 5 stocks will move, then only your underlying will move and then only you can be the options buyer. Otherwise, if these stocks are moving, not moving, your HDFC moving, but your ICICI Bank and Axis Bank is falling down, that means your market, your Bank Nifty cannot move. So apart from your options data or the technical setup, the common sense of behavior of the Hayward's counter is very important. Apart from that, there are many indicators, looking at the options band, looking at the volatility index, looking at the OI concentrations, which strike is having maximum put OI, which strike is having maximum call OI, then rollover activities, volatility, vol smile, vol skews. But I think better to discuss more about the basics. If you are clear with the basics, I think the other part you can learn or you can read from anywhere as well. Now just let me make it open for you guys, because more we make it interactive, even you and me both will enjoy. So I'm opening this session for all the participants. Better you ask more questions and clear your doubts. I think that will be better. YuvaLeads Foundation, can we open for all the public or can we open one by one as per the queries or questions? I want to make it interactive for half an hour. And I think that will be only best way to learn from the people who are knowing the market in practical way. So YuvaLead, can you open one by one? Can we open for first Alpha Upadhyay and then Chintan and Delin one by one? We can open and we can ask their questions and I can reply. So everyone can hear and get the query accordingly. Can anyone unmute and ask anything? But don't unmute all the people at a time. Otherwise, there will be the chance to reply. Speak your name and then ask the questions. I think that will be better. I think who's opening now? Can anyone unmute and ask the questions? Whatever you understood, and if any doubt or you want to know anything from me regarding to the derivatives and technical, anything related to career, anything related to the trading ideas, anything related to the market movement or any basics, which studies is better or what indicator is better. I think Daniel wants. Yeah, Daniel, yeah.
Sir, basically, I want to know how can we analyze the market, basically current situation when most of the economists are saying that it's in recession, but while seeing the market, it's in green, basically. So it's like how to analyze, basically, for beginners.
Yes. So thank you, Daniel. Thank you, Daniel, for your question. See, what I understand, first you need to know what's your style all about. And that's why I started with the picture, with the test matches, one day or T20. So first you need to know what's your style. If you're
Sir, it's
yeah,
sir basically for swing or in positional means basically long
yeah.
trade.
Okay, but need to understand swing and positional have the different way. When you're looking for positional, then only you need to look at the fundamentals. But if you are a trader, you need to look at the technical and derivatives rather than looking at the fundamental. Because when you are a swing trader, you need to focus on the demand and supply rather than talking about fundamental. You cannot say the Reliance is a good company and every day it will move up. So there are two ways to understand it. First is the technical study. Second is the derivative studies. Technical study is all about demand and supply. Demand and supply means a particular price moves up or down. I'll just give an example. If I can share my chart, let me see. If I can share my chart, I can explain you that how technical study is being done. Yeah. So now, shared. Okay. Can you see this chart and ask Daniel? Can you ask any question related to your stock? I can reply.
Sir, I was particularly tracking Tata Motors from past few days, its performance
Okay.
and everything. But
Right.
I'm
Okay.
not.
Clear. I got your questions and I'll reply you. How to look at the chart and how to know the market sentiment without looking at the fundamentals. Because you don't know what the fundamentals happening, what the mystery and the your Tata are doing, what is happening in the Europe or in the Middle East or the India or the UE, because you are just following the people. So what I understand, there are many Gujarati crowd, they say Bhav Bhagwan Che. We only know the price, nothing else. So what I understand, whenever you need to know about any stock, you need to look at the 3-time horizon and then come to the conclusion based on your requirement and the risk appetite. Now let's say I'm looking at the monthly chart. This is my monthly chart of the Tata Motors. And if I ask you what is the trend, everyone will see trend is negative. I'm looking at the yearly chart. Let's say this stock is continuously falling from last 4 years. I'm looking at the monthly chart. From last 3 months, it has fallen down sharply, but in this month, it is slightly up by 5%. So what is my overall trend? Overall, it is falling down. And I've noticed whenever it bounces, it goes down only. So my trend is sell on bounce or the trend is in weak because this stock is continuously making lower top, lower bottom. I'm sure everyone must be knowing about the chart, whether the line chart or the bar chart. This graph is even going down to the lowest part of my laptop. So this is, I'm looking at the candlestick. So more I'm looking at the candlestick data setup. Now I'm going to the weekly chart. So my monthly is negative. Now looking at the weekly chart. And if you look at the weekly chart, we have seen some buying interest, but the follow-up is missing. Earlier, it was continuously making lower top, lower bottom. It recovered because your entire market recovered. But now the recovery is not seen. This stock is finding pressure. But important part is couple of weeks back, it has broken its multiple support of 106. After breaking 106, it's never moved up. Continuously falling down. Even it made low of 75. So for me, even breaking of 100 will be very tough. Now I'm looking at the daily chart. Look at the stock, hardly there is recovery. Whenever it recovers, it witnesses selling pressure. So if I look at the trend study, for me, this counter is negative. Even I look at the monthly chart or the weekly chart or the daily chart. Some bounce could be seen because recently it has taken multiple support near to 70, 71. If you look at here, it made low near to 71. Here it made low near to 65. Here it made low near to 71. So people might be accumulating near to 70, 65, 71. But the problem is follow-up missing. So to conclude the trend setup and the derivatives data, the trend is weak and bounce are being sold. So if trend is weak, better to avoid. Only rule applies in the trading is follow the trend. Trend is only friend in your market. Daniel, I think I have replied in a proper way with looking at the chart and the trend study of the particular counter.